Welcome to The Explainer. Today, we're going to cut through all the noise and rank 10 of the most common trading strategies out there. We'll show you what actually works and maybe more importantly, what you should probably avoid when you're just starting out. So, if you're looking at the world of trading and it feels like you're staring at this giant, confusing maze of strategies, breakouts, indicators, smart money, let me just tell you, you are definitely not alone. That feeling of being overwhelmed is completely normal. That's exactly what we're going to do in this explainer. We're building a simple roadmap for you. We'll take these 10 strategies and rank them into 4 clear tiers, from D all the way up to A, so you know exactly where to focus your time and your energy. Okay, let's dive right in, and we're going to start at the very bottom of the pyramid. Think of this part as clearing out the minefield. These are the strategies that are often major traps for beginners. Earning the lowest possible rank, the D tier, is something our source calls indicator overload. You've probably seen this. It's when a trader's chart is just plastered with popular indicators. Things like the RSI to measure momentum, Bollinger Bands for volatility, or the MACD for trends, all in the hope that somehow this messy combination will magically reveal a perfect trade signal. But here's the fundamental problem, and it's a big one. Almost all of those are lagging indicators. They don't predict the future. They just confirm what's already happened in the past. The price moves first, and then the indicator reacts. This means you're always acting on old news. And our source is incredibly blunt about this. If you ever see a chart that's so cluttered with lines and graphs that it looks like a toddler's drawing, that is a huge red flag. It's a sign of total confusion, not a real coherent strategy. All right, moving up just one notch to the C tier. Now this is where it gets really interesting, because we find some of the most famous textbook concepts in all of trading. Breakout trading, moving averages, trend lines, and classic support and resistance. But here's the catch. When they're used all by themselves, they are often just traps waiting to happen. So you might be wondering, but wait, why do these classic methods so often fail today? Well, you have to understand the modern markets are incredibly sophisticated. They're basically designed to hunt for liquidity and trigger all the stop-loss orders that beginners place at these really obvious levels. This leads to countless false signals that can just burn through a new trader's account. Okay, let's move on up to the B tier. Now, let me be crystal clear. These strategies are powerful. They absolutely work. But, and this is a big but, they are just not the ideal starting point for a beginner because they are seriously complex. To really get what the B tier is all about, you first have to understand the term smart money. This isn't about you and me, the individual retail traders. No, this refers to the massive institutional players. We're talking the big banks, the hedge funds, the ones with enough capital to actually move the markets. So this tier is home to strategies like smart money concepts, or SMC for short, inner circle trader concepts known as ICT, and trading based on liquidity and stop hunts. You see, all of these systems are designed to basically follow the footprints of that smart money, but man, they come with a really steep learning curve. Now, it's really useful to know the difference between SMC and ICT. Think of SMC as the foundational theory. It focuses on these key institutional ideas, like order blocks, which are basically price zones where huge orders were placed. ICT takes those same core ideas but builds a much more detailed and intricate system around them. So while some of the best traders in the world use these methods, our source is pretty clear. Trying to learn this stuff on your own from free videos is a really tough climb. All right, and now for the moment you've been waiting for. We're moving all the way up to the A tier. These are the 2 strategies that are highly recommended as the absolute best starting point for any new trader looking to get their feet wet. The first strategy in the A tier is it's a thing of beauty. It's a combination of the market's natural rhythm and a really powerful mathematical tool. We're talking about Fibonacci and pullback trading. So the whole idea is actually pretty simple. See, markets don't move in straight lines, right? They move in waves. So step 1, you identify a clear trend. Step 2, you patiently wait for the price to pull back for a bit. Then you draw your Fibonacci tool on that move and you look for a high probability entry right around that golden ratio level. It's elegant, it's logical, and it's effective. Now, the second A tier strategy is a total game changer because it completely shifts the focus from how you trade to when you trade. This is all about using market timing to your advantage. More specifically, it's about understanding that the huge global Forex market operates in 3 major overlapping sessions every single day: the Asian session, the London session, and the New York session. And here's the secret. Each one has its own unique personality and its own predictable trading characteristics. And this right here, this is the biggest advantage. Instead of being chained to your desk all day long, you can focus all your efforts on a very specific high-volume window, like the first couple hours of the London Open. This is when institutional algorithms are most active, and they often create repeatable patterns you can capitalize on. It respects your time and, most importantly, your focus.
Okay, wow, we have covered a ton of ground here. From the absolute worst strategies all the way to the very best for beginners. So now, let's put it all together in one clear visual that you can use to really guide your next steps. And here it is, your complete roadmap. As you can see, Tier A is your best start with Fibonacci and session-based trading. They have simple logic and they're effective. Once you find your footing there, maybe you can start exploring the more advanced Tier B concepts, the C-tier strategies. Use them with caution, maybe as a secondary confirmation tool, but never rely on them by themselves. And as for Tier D, indicator overload, the advice couldn't be simpler. Just stay away. So, this explainer has given you a framework, a map that can hopefully save you from months, maybe even years of trial and error. But the real learning, that starts now. So the only question is, which path are you going to choose to explore first?